Hi, my name's James Forbes, and I'm the General Manager of Consumer here at Equifax, and I'm your host today. Brokers are an integral part of the banking system here in Australia, and today I'm joined by Peter White, Managing Director of the Finance Brokers Association of Australia, to talk about how brokers are adapting to changes in the mortgage market in Australia. Welcome, Peter.
Thanks, James. I really appreciate being here on the podcast with you.
No problem at all. So look, for our listeners and for our viewers, can you please introduce yourself and maybe give us a little bit of your background?
Oh, I'll give you a quick elevator pitch. So Peter White, as you said, Managing Director for the association, FBAA. Been in the industry 43 years, just about to click into my 44th, and cut my teeth in mainstream banking with major banks and progressed through a whole host of different things over the years with investment banks and private banking, and non-banking became a big passion of mine. I set up Rams Home Loans first sales office in 1993 and got involved with the association in 2003 as state manager in New South Wales, and it wound up being all-consuming in one's life, which these sort of things tend to do if you're not careful. So when I was appointed to Chairman of the Board, National President in 2008, 2010, I took over full-time as CEO. And the rest is history. I'm still here.
That's fantastic. So look, Peter, we're living in quite changeable economic times. How have raising interest rates and rising inflation impacted the volume of applications that brokers are seeing and their workload overall?
James, it's very interesting, and from my point of view, not unexpected. But brokers are busier than ever. They were through the GFC, and they still are now. Volumes are continually increasing, and it's driven because of the changes in these markets. And whether you look at where inflation has hit, and for quite some time, I don't think as a country we realised how high that had risen. Yet the activity for brokers was still continuing, looking to refinance, purchase, whatever it may be, to get better interest rates, better deals. And of course now, as we've seen the long-awaited rising interest rates and taking some fairly seriously big jumps, and more to come, I dare say, brokers are very, very busy on that refinance sector. Everybody's looking to try and get a better deal. This is always the case, but this is always the situation. Over the decades I've been in this industry, rising interest rate market heats up refinances. Those who have maybe better financial positions from an income point of view will see some opportunities in the marketplace that they'll take that opportunity and buy those. So there's sort of a heated spot over here for the lucky ones that are in the right position, and those who want to refinance are really going hard at it, and it just keeps the market solid. And at some point that'll all turn as well.
Yeah. Do you see mortgage applications or the volumes plateauing anytime soon? Do you see the cooling housing market potentially having an impact there?
Yeah, it'll be interesting to see. I'm a bit of an each-way bet on this. I hate being a fence sitter because I'm not known for that. But it will be interesting to see. I fear that we'll get another 50 basis points rise in the next RBA review. We've seen the ASX futures predicting that the cash rate will hit just around 3.4% and pull back to about 2.99 by the end of next year. So these are going to push interest rates up a fair bit. I've been saying for a long time that, and prior to rates starting to rise, that I would see that when rates do go, they would sit somewhere between a standard variable home loan rate of 4.5% to 6%. It looks like I'm not far off the money, and it'll sit somewhere, maybe peak at 5.5 and pull back to 5 or just under. But the cause and effect of that is it's going to change the dynamics of applications. Whether it slows applications is the big toss of the coin. The style of application will probably be heavy refinances. People try and cope with higher repayments. As I said, for the luckier ones that are in a better cash flow position, they'll be able to pick up some purchase, because it will at some point start and pull the property market back a bit. Now, we're already seeing part of that. And again, I was on record a few months ago, so saying, well, you're probably going to see somewhere upwards of 15 or maybe 20% drop in property rates in certain pockets. I mean, certainly not a spread. We've already seen 10% in quite a few places around the country. I don't think we'll get to 20, but some places will. I mean, we've seen where I live in Queensland, property prices are just basically increased by 50%. It's just not worth it, and it's probably not sustainable. But as people's affordability changes because of rising interest rates, the actual buyers are going to reduce. There'll still be buyers, but the number of buyers will reduce, and that will put pressure on people who want to sell to pull their asking price back a bit, and that's going to turn around and have an impact on property prices as well. The level of activity, I think, is going to stay pretty heated for a while.
Yeah, we're certainly, Peter, seeing a lot more refinancing activity, much less activity from new home buyers, but the volumes are sort of been stabilising. So in that environment, Peter, where we're seeing a lot more of that refinancing, how are brokers getting involved to sort of really assist their clients and I guess really and maintain them through the sort of change?
Well, again, let's say brokers have been extremely active. So there's a whole host of things happening in the marketplace to assist borrowers with where they are now and in preparation for what to come. Because one of the tricks in the marketplace is that you've had a whole lot of borrowers fix into some really cheap fixed interest rates, right? They've got things in the high ones or early twos, but when they step out of that, interest rates are likely going to be 5% or around that sort of mark. So that's a big differential for what you've been paying now and what you're going to pay when you step out. So there's a lot of education happening in the marketplace from ourselves and from aggregators and so on, saying, look, what you probably need to do as one consideration amongst many is start to educate your borrowers. Say, look, if repayments were here, it's going to cost you this much more. So take that piece and put it in a separate account. Put it somewhere where you don't see it. Don't spend it, park it, so that you are used to what that's going to look like when you step into it and not then fall into this deep dark hole. Oh crap, I can't afford these repayments, because you adjust your discretionary spending and so on to what it is you got available in your bank account. So there's a lot of education happening around that style of commentary, and also dealing with the clients, reaching out to them, just asking them, how are you going? Are you travelling all right with your repayments? What if it turned out and your repayment went to this mark? Where does that leave you in the marketplace? So there's a lot of activity, I guess, behind the scenes, if I can put that, direct between broker and borrower, just as a mortgage health check style of thing. Because as those interest rates change, people, a lot of people will be able to afford the repayments if they're in the right space, but they may not be able to move, because as we know, the servicing rate, floor rate, whatever you want to call it, is another 2-3% higher depending on the lender, and they may not afford that servicing rate, but they can afford what they're doing now, but they then become trapped. And so the old mortgage prisoner title starts to float to the top again as well. So some interesting challenges and balances as we go forward.
Yeah, so you really see brokers playing a much broader role supporting their customers than just purely around the application.
Yeah, and it's, when we say, I guess, I don't know if it's a broader role, but a more proactive role. And brokers have always done this, but more proactively in almost, I'm not really happy with the term, but mortgage planning, like planning for the future and understanding what that's going to look like, versus this incredible long period of either 11 years of reducing interest rates or sitting at a very, very low interest rate for quite a long time. And now all of a sudden we're on this elevated run, and so many borrowers have never been there before, and there needs to be a lot of care and management for all of those borrowers.
Yeah, absolutely. Absolutely. Look, fast turnaround times for loan approval has been a key issue for brokers and their customers for a very long time. And we speak to banks a lot. They're focusing heavily on reducing that time to yes. What are you seeing as best practice in the market around that? And how does that, that compressing of the mortgage approval time impact a broker's business?
James, I'll be a little bit cheeky and say I don't think best practice has been achieved yet, but there's certainly some great improvements in the marketplace. It's one of those things whereby I guess that it has been a loud conversation for a long time, especially through COVID, where a lot of the lenders turned around and had offshore processing centres. They all collapsed as well, and everything had to be brought back onshore. Things were taking a ridiculous amount of time to get approvals. That has all sharpened right up, and banks are now, and I'm travelling around the country at the moment, about a 3-week period, and I'm constantly hearing the banks saying we've pulled back our approval times. It's 4 days, it's 1 day, it's if they're digital platforms, it's a couple of hours, whatever it may be. There's a whole host of things that are changing and moving around that space. So the banks have obviously listened to the outcry of industry, but also too, the outcry of industry is more about you've got a consumer, a borrower here who is suffering because you're in inadequacies. You've got to get it right. And then there's imbalances between broker and branch networks, where branch networks were getting, if you like, favourable turnarounds times, and the brokers weren't. All these things are balancing out and rationalising, which is a really good thing to see. When you see that the borrower's market penetration is north of 60% of originated loans, there are reports of it hitting 70, whether it's actually really there or it was a spike, and whether that falls back a bit. But I think over the next few quarters we'll be able to see the measures as to where the consistent measure is. But I've always said that brokers, and I've said this since 2016 actually, I was on a study tour overseas and I was looking at different markets and came back to it. Brokers will hit 70% penetration of market share, and they have every likelihood to achieve 80% with time in the decades to come, largely driven by the grunt work being done through technology. And the fact that this whole industry is premised off the needs of the consumer. So if I go back into the 90s, the thing that drove this in the 90s, when broking first started, right, and I'm talking early 90s here, so the 92, 93, and then as we hit 95, banks were shutting branches all around the country. Some brokers stepped up to the plate and say, hey, I'll come see you. You tell me when, what time, where, I'll be there and at school. And the consumer loved it, and it drove the market share. And so long as we're providing those services, it will continue to happen. Speed of turnaround, approval times and settlement times, and taking manual human interventions out of that grunt work piece, will see market shares only continue to improve, because this is what the consumer actually wants.
Yeah, technology, it's a really interesting question. Obviously, we're seeing that being applied right across the board to drive efficiencies. How are brokers specifically sort of adopting technology in their practices to help them do business better?
Yeah, there's a large adoption in technology, and there's also a lot of work to develop even better technologies. So there's various platforms. Usually comes through the aggregator, so the umbrella company sitting above the actual broker, who provide the technology services to get loans submitted and into the process with the lenders and get that all moving nice and quickly. And but there's still a lot more to be done, and there is a lot more currently being done to actually improve all of those things. And I guess like anything, you sort of put your toe in the water of something. You say, well, this is a great piece of tech. And then as time goes by, you say, oh, I can tweak it here, I can improve it there. Oh, this wasn't here when we first did this, we can now do this. And so that technology growth will continue and expedite the opportunities in the marketplace for brokers. And the brokers have adapted to it really, really well. If I went back 5 to 10 years ago, where things were starting to boil along in the tech space, the adoption was a little bit slow. Everybody's used to more manual processing. It took a bit of time to get everybody on board, but it happened. And even now, we're finding that many brokers, not everyone's got a website sort of things, but I don't call that tech. I call that as a marketing piece you need to have. But they're starting to build smart tech under it to help integrate with these other systems. And to me, the great future is the end-to-end solution that actually still doesn't exist. So it starts on your website, integrates into your processing, your approvals, into your settlements, and you're done without human intervention. You're still going to have the people contact. It doesn't take away the human beings. It just takes away all the grunt work. At the moment, we've got some stops and gaps in the process. Once they're eliminated, and especially with as blockchain grows, and the open banking platforms grow and are really embedded into the systems in a normal way rather than a piecemeal, sporadic way as it first steps out, will be enormous advantages to our industry, because things will just, and they're done.
What's your sense, Pete, around the timeframes for the adoption, or maybe at the mass adoption of open data in that mortgage process?
I think it'll be pretty quick once it gets its fluidity, and I think next year we'll see some interesting times, probably in the second half more so than the first half, only because as things get going, you sort of got to get your momentum, your steam up, and I think the second half of next year will be interesting in that space. I think it will set the premise for other things to develop off it that will then improve things yet again. We've got to watch it. It's all well and good for mortgage brokers. I know that's the bigger piece of the market, but finance brokers are cut out of this largely because of the way regulation's being written. Because the past government was trying to get the extension, to get the part of the responsible lending repeal was the extension of the best interest duty. So finance brokers who don't do home loans at all, they only say do consumer asset stuff, don't have a fiduciary obligation under law. They don't have a best interest duty, and therefore they're going to have difficulty with CDR, open banking, because of that's not there. But there are intermediaries trying to fill that hole. I think that, like I said, second half next year, and as we go through the next 5 years, I think it'll be a really exciting time as to where technology goes, how it's adapted, and how it fulfills a delivery, unlike what we've seen now.
Yeah, that's great. You mentioned best interest duty, Peter. Obviously, that was introduced back in 21.
Yep.
How have brokers gone about adapting to its introduction, and are you seeing that that's now well embedded within broker practices?
Well, touch wood. I've not heard any disasters as yet. I know ASIC's doing a whole lot of auditing, and I've had early conversations around how that's going, and there doesn't seem to be any regulatory issues of great note. I mean, none of us are perfect, right? So you're going to find something. But I know that brokers adopted to it like duck to water. It was brilliant. The technology stepped up again, so that all the aggregators built and enhanced their technology to adequately, cope with the obligations under the best interest duty. And although it's more work, and the common complaint is I have to do more, I don't get paid anymore, etc., etc. But the brokers have adopted well to it. And the current auditing, both internally through groups and externally by the regulator, are showing that these things are ticking the box. They have been adopted well. There'll always be areas where you could do better here, or you need to fix this up there, or whatever it may be. And there'll be odd one that trip right over the wire. I mean, that's that's life. That's part of being human. But principally, it's going very, very well, and industry should be very proud of itself in doing that. It was a scary piece as it led into it for many. I always said it was going to be the best thing for the industry, because I could see that duty, that obligation, heading that journey up for market penetration, market share through origination to that 70% piece. Because from my point of view, the broker can go out and say, I, by law, act under your best interests. The banks don't. Now, I know there can be arguments around the banking code of practice and code of conduct, all that sort of thing, but it's an obvious thing. You have a piece of law that has huge penalties behind it now that we can argue and debate. Brokers have always acted in the best interest of the borrower, but now there's a piece of law that says you must, and then there is measures as to how you must looks like that reinforces those outcomes, and it's working really well. So I was very excited for it to come in. I'm very pleased how brokers have adopted to it, and the industry broadly, and so far, so good.
Yeah, it can only be a good thing, reinforcing the role of a broker to act in the best interests of their customers, and I think it really strengthens the industry and the whole mortgage ecosystem more broadly. Look, thanks very much, Peter, for joining me today. Thanks for sharing your insights around how brokers are dealing with the current economic climate. Really enjoyed the chat. Thanks so much.
My pleasure, James. Thanks so much. I look forward to having another one day.